you, Carol. Very good afternoon, everyone. On behalf of Asian Market Securities, I welcome you all to the Somany Ceramics 1Q FY24 result conference call. We have the senior management team with us to take us through the results and then for the question and answer. With that, I'll hand over the call to Mr. Abhishek Somany for his opening remarks. Over to you. Thank you.
Welcome, ladies and gentlemen. This is Abhishek here. I'm assisted with Sailesh, our CFO, and Sunit. To give you a feedback on an overview of the first quarter. The first quarter, there has been pressure in the market, and therefore our capacity has been utilized in a very low way. To be precise, there's been a 70% capacity utilization as far as tiles are concerned, which clearly shows up in the working. As you know that in the tile industry, the biggest lever is capacity utilization. Silver lining is that from 1st July, we're almost at 100% capacity utilization. So things are looking much, much, much better. Anyway, so for the last quarter, that impacted the sales as well as the margins. As far as sales is concerned, we grew by 8%, and we were looking at a double-digit growth, as mentioned earlier. We are still slating that we will be looking at a double-digit growth for the year. This quarter, which is Q1, has had some other pluses, which is the gas pricing has stabilized between April and June. Currently, our gas pricing is looking between mid-40s to early 40s, depending on the region, coming off from the mid-50s to the early 50s. So that has been a reduction in the gas pricing, which is where you're seeing the EBITDA margin 60 bits, which is up. However, if the capacity utilization would have been 10 to 15% better, which is what we were envisaging, this EBITDA margin would be much better. Therefore, you can look for it for this quarter. We should be looking at a much better quarter. As far as sanitary ware is concerned, sanitary ware did not grow in the quarter, but bath fittings grew by approximately 20%. So an overall growth of 8% in the sanitary ware. This is something, again, which has picked up in the second quarter. As far as our advertising is concerned, we were in line. We did about 2.6% of revenue in the advertising. We had taken up the IPL, and we sponsored one of the teams, or rather co-sponsored one of the teams. As far as our balance sheet is concerned, we have been focused on overall working capital management, and therefore the balance sheet is absolutely under check. Our debtor days have come off 2 days, from 40 days to 38 days, and our inventories are also down by a day, but that largely on the backdrop of using lesser capacity. So there has been lesser capacity utilization. Coupled with that, we had taken certain routine maintenances. So overall, these capacities are back on stream, and we are up to a much better quarter. The other thing which has been noteworthy in the quarter, in fact, which is shown in the result, is again the line balancing. What we have done is Somany Fine, which was making soluble salt products for us. Soluble salt product is part of the PVT portfolio, and so PVT has double charge, clean charge, and soluble salt. Soluble salt, that plant was producing about 4.5 up to 5 lakh square meters. Our current demand for soluble salt is slightly lesser because this particular material has gone only into projects. So we need about 3.5 lakh square meters, and it was a chicken and egg. The plant was not running at 100% capacity, therefore not being able to give the pricing. We thought it prudent to sell the plant and buy the soluble salt from elsewhere, which has already been tied up. This plant has been shut for the last 3-4 months, and we've had zero sales loss because we are buying the soluble salt from other parties who are running the plant 100% and selling to various different suppliers. So that is what has been a prudent move on our part to exit the JV, but rest assured there will be zero impact on the material availability. There's more than enough material available as we speak of soluble salt. As far as our showrooms are concerned and network expansion is concerned, we expanded the dealers in the first quarter by 50 plus dealers, net addition, and we did about 25 showrooms, net addition. So this has been the overall overview of the last quarter. Happy to take questions now. Thank you.
Thank you very much. Ladies and gentlemen, we will now begin the question-answer session. Anyone who wishes to ask a question may press star then 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Keshav Lahoti from HDFC Securities. Please go ahead.
Hi, thank you for the opportunity. So I want to get a sense on the demand. The Q1 has been muted.
Excuse me, sir, this is the operator. I'm so sorry to interrupt. May I please request you to use the handset mode while speaking?
Is it better now?
Your audio is not clearly audible, sir. Can you please speak a bit louder?
Yeah,
Thank
sure.
you.
So my question is, how is the demand shaping up in Q2 and when you expect the demand revival?
Q2 is much better than Q1. July was also better than the average of the 3 months in Q1. I think the demand finally will look up completely post-Diwali, but for us, we should have a much better quarter in Q2 itself than compared to Q1.
Okay, got it. Can you give the fuel price breakup region-wise for Q1 FY24 and current prices?
Q1 FY24 was 46 rupees as far as the northern plant is concerned, 43 as far as the western plants are concerned, and 57 as far as the southern plant is concerned. Current pricing as we speak this month, obviously every month it's been going down little by little. I gave you the average of the Q1. Current prices, the northern plant is looking at 41, the eastern plants are looking at 40, and the southern plant is looking at 50. These are all figures as standard cubic meter.
Okay, got it. Lastly, what is the update on the capex? Is it running on track, and what sort of capex we should expect for FY24 and 25?
FY24 and 25, the only capex which is pending is our large format tile, which will start production sometime in Q3, early Q3.
Okay, got it. No further plan as of now for future?
No further plan. With this plant starting, the addition in capacity in the last 24 months would be approximately 25%. So a lot of work to do on sales.
Got it. Sure. Thank you. That's it.
Thank you. The next question is from the line of Jenish Karia from Antique Stock Broking. Please go ahead.
Yes, thank you for the opportunity, sir. So if you can please highlight on the gross margin contraction, excluding the power and fuel cost, both on YOY and sequential basis.
Yeah, I would let Sunita Sailesh take that question.
So there is actually a gross margin improvement this quarter, both QOQ and YOY. If I have to talk of numbers, I think QOQ, the gross margin expansion is 0.9% and YOY it is 1.2%.
So if I exclude the other income and power and fuel costs, so it seems that there's a decline. So it has gone down from 54% in last quarter to 53% now.
Power and fuel is a part of gross margin only, so you'll have to include that. And when I give you the numbers, other income is not included in this. This is the actual operating gross margin. Power and fuel is a part of our cost.
Okay, no problem. So can you just help us with the product mix for the quarter, if possible?
I'm sorry?
The product mix between ceramics, GVT, PVT.
Yeah. The product mix has improved in favor of GVT. If I look at Q1 FY23 or even Q4 FY23, we are up by 2%. So we are at 33-34% of GVT. PVT obviously has declined by 2%, and ceramic has also declined by 1%. So overall, GVT has gone up by 3-4%, and the other two have declined by 2%.
Sure, that's helpful. I'll come back and let you. Thank you.
Thank you.
Thank you. A reminder to the participants, if you wish to ask a question, please press star then 1 on your touchtone telephone. The next question is from the line of Ritesh Shah from Investec. Please go ahead. Mr.
Hello.
Ritesh Shah, you may please go ahead, sir, with your question.
Yes, sir. Sorry, I was on mute. So thanks for the opportunity. Couple of questions. Sir, you did indicate the regional gas prices for Q1, and you gave also spot. So can you help with Q4 FY23 prices and blended cost for Q4, Q1, and right now?
Q4 cost was 51 in north, 50 in south, 50 in west, and 59 in south.
And sir, on a blended basis for Q4, Q1, and right now?
I'll have to work that out. I don't have the back of my hand. But right now, I told you it's 41 in the north.
40.
Very good.
41, 40, 50.
Oh, sorry. I have the blended. I'm sorry. 45 was Q1 FY24. 61 was Q1 FY23. And 50 rupees was blended Q4 FY23.
Sir, can you please repeat? Sorry, I missed it. 50 rupees.
So I'll give you last year Q1 61.
Right.
Last year Q4 50. This year Q1 45.
And spot?
There's no spot.
Sir, you said 41, 40, and 50. If one had to do a weighted average, how much would that come to indicatively, sir?
Ritesh, so the 41 is the blended at the current level, which is the current metrics, right? And the breakup amongst the geographical location is 41 at a northern plant, 40 at a western plant, and 50 at the south plant. So blended coming to 41 at the current level, which as of now.
That helps. Sir, so the second question is, what sort of cost savings are we looking at if one just had to extrapolate this rupees per SCM into consumption norm based on our mix of GVT, PVT, ceramic on a rupees crore basis? And a follow-up to that would be, do we expect this cost savings to translate to higher margins, or are we looking to pass on some discounts? How should we understand that?
So the sales price really haven't declined in the first quarter. Whatever margin reduction you're seeing is purely because of lesser value added being sold in the first quarter. So sales price is not under pressure to that extent. It's just been the market. We've passed on some discounts, but that's to use capacities, old material, etc., but not really under. I can't point it out as a flag as to sales price is under pressure. So going forward, you're seeing the 60 bits up, even though our capacity utilization was probably the lowest ever at 70%, which is back to 85-90% as we speak from 1st of July onwards. So you will see that coming also, and the 60 bits is anyway coming as cost advantage in terms of gas. So looking good for second quarter.
Right. And so just a related question, how much would be propane and Gujarat gas pricing right now? What I'm trying to understand is the positioning of, say, Morbi versus for us, west you indicate 40 rupees. Are we above or below that? And does it mean anything for us?
We have 6 plants, out of which 4 plants are running on propane as we speak. In fact, 5 plants are running on propane as we speak. And 1 plant is also getting the propane bullet. But as of today, the propane price, because the government increased the taxes on propane, was just a wee bit lower than natural gas. That is why we were running propane. But next month onwards, I think propane would be higher than natural gas is what is predicted, in which case we will move to natural gas, which is at 40 rupees. But I don't remember the exact figure for propane, but I think propane is at about 38, 39 rupees, and natural gas is at 40. There's a correction. There's only 4 plants which are running on propane, 2 are running on natural gas. So blended, we're still at that 40 rupees. And I don't think that's going to change. It will be that 1 rupee plus or minus.
Sure. This is helpful. And just last one question I'll try to squeeze. Sir, other players are looking to set up facilities in Eastern India. How do we see that as a cluster emerging? Would we look at anything on Eastern India to cater to that particular market? Thank you so much.
One player which is doing anybody some information on that.
So your voice is breaking up. Hello?
Yeah, I have only heard of one player doing Eastern India, unless you have better information on that.
Correct. Sir, so right now it is one. What we are hearing is there could be incrementally more. So the question is, sir, any thoughts on that direction, on a manufacturing base in Eastern India? Does it make sense? Would we even look at it in that direction?
Requesting the participants to please stay connected while we have the management reconnected to the conference. Requesting all the participants to please stay online while we have the management reconnected to the call. Thank you. Requesting all participants to please stay connected while we have the management reconnected. Participants, requesting you all to please stay online while we have the management reconnected to the conference. Thank you.
Hello?
Yes, sir, you're reconnected. You may please go ahead as we have Mr. Ritesh Shah still online.
Ritesh, I know only of one player who's doing something in the east of India. I don't know anybody else who's doing it.
Correct. Sir, so the question is, do you see merit in that particular move, and would we even look at setting up a manufacturing facility in Eastern India, factoring the sizing of the market?
Right now, our next capacity which is coming up is Nepal, which will be sometime next year.
Okay. Sure. That helps. Thank you so much.
Thank you. Before we take the next question, I'd like to remind participants, if you wish to ask a question, please press star, then 1 on your touchtone telephone. The next question is from the line of Achal Lohade from JM Financial. Please go ahead.
Yeah, good afternoon. This is Achal from JM Financial. Sir, a few questions. One is, with respect to value-added mix, can you help us for 1Q FY24, what is the number? And similarly for 1Q FY23?
GVT should be up by another 2 to 3%. So it should be above 35%. It's currently at 33%.
Sorry, you're saying in 1Q FY24 it is 33%, right?
No, in FY24 it was 32, just shade under 32, and it should be above 35% in FY24. Q4 23 was around 31, 32. It should be above 35% in FY24.
Right. But in the just recent comment you mentioned the margin reduction is due to lesser value-added sold. So I'm just curious.
No, lesser value-added sold has nothing to do with GVT. I'm talking of within GVT, there are different sizes. So the higher sizes and the lower sizes yield lesser, so marginally lesser. That is why we've not been able, when markets are under pressure, people buy only the vanilla items. So within GVT also there is 3 different categories. The vanilla made the high. That's what I meant.
Right. Is it possible to get a number like, a competitor talks about mid-40s kind of a value-added tiles mix, which has higher margins. Is there any number we could quantify for us?
Yeah, so we also have an internal number as to what we call as value-added. I don't have the numbers exactly in front of me, but yes, that is exactly what I'm saying is which been slightly lower. So, for example, I'll give you an absolute example. So, 80 by 160 inches is a particular kind of tile, and 120 by 180 is another particular kind of tile. That has sold less than what we would have envisaged versus the 60 by 120 tile, which is sold more in place of the 8160.
So basically you're saying that, there is an element of down trading given the demand weakness, given the inflation and, from a customer perspective. So it has nothing to do with us in terms of the availability or production side of it, right?
No, nothing. Zero issue.
Understood. And could you remind, I couldn't understand really very clearly, the reason for capacity utilization was the issue with the PVT, and hence we kind of discarded the capacity or got rid of the capacity, and hence the utilization was lower. What is that?
No. Utilization was lower period in the quarter. We had couple of scheduled maintenances, which was great. We were good that we did the maintenance then, but other than that, the market was slow, so we had to shut down a few other lines. So the overall capacity utilization was lower. What I was mentioning was Somany fine. Somany Fine particularly makes a specific product called soluble salt. Earlier, we were selling 6 lakh, 7 lakh square meters in the erstwhile days, 4-5 years ago, when soluble salt had the fancy of the market. Then that dipped to 4.5, 5 lakh square meters. We still were in good shape to run the plant. 6 months ago, this particular product has started selling only 3.5 lakhs square meters per month instead of the 4-5 lakh square meters which the plant could produce. Now, because the plant was running at a lower capacity, it was not being able to give me the right pricing. There were other players in the market who were making these vanilla items at a lower price. Therefore, we shut down the plant 4-5 months ago. We tried our best to revive it and revive this market, but the market has stabilized at that 3.5 lakh square meters per month, more or less ballpark, which does not justify running the plant at 100% capacity. Therefore, we have sold the plant. The partner will probably make soluble salt. We will probably buy back material from him. That I don't know. But there has been no loss of sales in procuring soluble salt. Why the partner will be able to do it in case he chooses to make soluble salt later, the person who's bought this particular plant from us, is that he will be running at 100% and selling to not only me, to other people also. That makes all the difference. In our own plant, we don't sell to anybody because that creates further confusion. So in our own plants, all our JVs are 100% dedicated to Somany.
Understood. Okay. The next question I had, if you look at the South gas pricing, it's, in fourth quarter also it was 60. And I think 1Q you said 67. Have I got the number right?
Yes. So yes, it was 59 actually, not 67, but 59.
59.
60, let's say. South was 60, is currently at 50.
Currently at 50, which is still a good 25% higher than what is there in the western pocket, which is Morbi, I presume.
Absolutely.
So how do we compete? Is that the freight cost takes care of that, or we are at a what kind of disadvantage in terms of percentage of selling price?
So the freight advantage is kind of nullified because the gas price is far more expensive, and this is, I think, confusion between a local gas supplier there versus IOC. So unfortunately, we work in India, and it's the government's two different government departments fighting with each other is why we are getting a spot price. So gas is available at 40 rupees over there, but PNGRB has not given any mandate to IOC to supply to us, so it's a confusion between the government departments. And for that, all consumers are facing the brunt. But this would also finally settle because the spot rates are going down worldwide, so this is also finally settled over time. So it's just taking a longer time.
Right. Sir, if you don't mind, can you help us in terms of, you have given the unit-wise cost or the region-wise cost, but if I were to ask you in terms of RAS gas, propane and the spot gas, what would that mix be for our company at Concall level, including...
We buy spot only in South, nowhere else. Okay. And everywhere else, in the West, we can only buy from GSPCL. There is no third supplier there. There is no second supplier. So in West, it is GSPCL. In the North, we are buying from GAIL, but we are also trading on the IGX.
Okay. Sorry, I'm still a little lost.
In the South, we are buying only spot. We don't have an option.
Right.
In the West, we are only buying from GSPCL. We don't have an option. In the North, we have an option of buying from GAIL and we are buying from IGX on the exchange.
So RAS gas is GAIL and IGL is spot, right? Have I understood right?
IGX is not spot. IGX is a blend. I don't know what that blend is.
Okay. And what tenure of these contracts are on the IGX? Is that like...
On GSPCL, it's generally a 3-month contract. In the South, it's an open contract. In the North, the GAIL contract is our 25-year contract, which will get over in 28, and the IGX is a spot trading.
Got it. This is very helpful. And
Mr. Lohani, I'm so sorry to interrupt.
When I say spot trading, please don't misunderstand. It's not spot gas. It's spot trading.
Right. You said it's a blend, basically. So there is...
Yeah. I don't know what the blend is.
Thank you. Before we take the next question, I'd like to remind participants to please limit your question to 2 per participant. You may rejoin the question queue if you have a follow-up. The next question is from the line of Akshay from Canara Robeco Mutual Fund. Please go ahead.
Yes, sir. Just one question, sir. You did mention that the demand to pick up post-Diwali. So what is it? Is it just a hope statement, or are you seeing some increase in the inquiries from the real estate developers or something? So just on this demand, if you can comment.
So real estate developers, we supply very little to. About 6-7% of our revenue goes to real estate. So a large part of our business is government and retail, mostly retail. And we have seen a better July, although the entire country has been rained out. North is one of our largest markets, and North has also been rained out in Himachal and in Uttarakhand, etc. Even then, we've seen a better July overall for the company. North, the kind of rain which we've had, obviously that uptake will happen in August. So overall, even though there's been a complete fallout in the backdrop of rain, we have had a better July compared to the last 3 months of April, May, June.
Okay. Yeah, that's it for me. Thank you.
Thank you. The next question is from the line of Amit Purohit from Elara Capital. Please go ahead.
Yeah, thank you for the opportunity, sir. So, just on the demand side, you indicated softness. So, would it be largely both project and retail, or is it largely to do with retail?
So, demand side is both project and retail. We have projects which obviously become slower in the rainy seasons, and also in June, you have extreme heat. Labor goes back to their villages. So, overall, demand has been slow. Inflationary pressures plus the labor pressures, which are normal, but overall the demand has been slow in the first quarter. But having said that, we still grew by 8% by volume. So it's slow, but it's relatively speaking. The problem is that we've put in so much extra capacity in the last 24 months. That capacity lay idle, and therefore we had a margin pressure. But that should get corrected the minute we start using capacity in a larger fashion. So I'm not worried at all. In fact, I'm very optimistic on that.
Sure. And sir, just on the, if you could help us in knowing this city-wise kind of tier 1 or tier 3, 4, where there was a more slowdown that you witnessed, or in terms of your overall volume growth, say about 8%, which is the markets where it has grown below 8% and where it has done above 8%?
So South has been slower. It's slower than 8%. Specifically, Kerala and 1 or 2 other areas has been slower. Telangana has been very good. North has been decent up till mid-June before the rains came. So overall, I wouldn't be able to give you exact figures, but our tier 1, tier 2, tier 3 or A, B, C, D towns really hasn't changed on an overall level by such a significant mark, which I would need to mention. So I think it's still in the same range of 75-25 between the tier 1 and the tier 2, 3, 4. In favor of the tier 2, 3, 4. 75 is 2, 3, 4.
And there is no significant difference between the growth trends in these two segments, right?
No, the tier 2, tier 3, tier 4 continue to grow faster than tier 1. But that's also because the tier 1 is a builder market, and we are not very, very penetrated in the builders. We are more focused on retail. That's why. But otherwise, tier 1 is also very large, which is where Morbi guys are supplying to the small and the medium-sized builders, even the large builders for that matter.
And then what does project includes for us?
Project includes only private. So we are categorized in 3 ways: retail, which export is part of the retail, then government, and then private projects. So when I'm talking about private projects, it means only private real estate developers.
Okay. And for us, what would be predominantly government projects, or would it be private builders?
I have that breakup. 75 to 80% is retail, 12% is government, 7% is private builders, 2% is export, and about 1% is the corporates. Corporates, I mean the organized retails, the Marutis, the Zaras, etc. of the world.
Okay, got it. Thank you so much, sir.
Thank you.
Thank you. Before we take the next question, I'd like to remind participants, if you have a question, please press star then 1. The next question is from the line of Yashovardhan Agarwal from Arthya Wealth. Please go ahead.
Hello. Am I audible, sir?
Yes, you're audible.
Yes. Hi, sir. So my question is on the COGS. So if we are including power costs in the COGS, then we can see a 2% improvement on year-on-year in the gross profit margin.
I can't understand anything what you're saying. I can't understand anything.
Hello?
I can't understand. Can you repeat, please?
Yes. So can you hear me?
Very little.
Hello?
Yes, your audio is very unclear.
Hello?
Yeah, go ahead. Yeah, better.
Yes. Yes. So my question is on the COGS. Sir, if we look, if we are including power costs in the COGS, then we can see a 2% improvement in our gross profit margins. But power and fuel cost on itself has corrected a lot. So, sir, I want to know that what are the other factors which are driving down our gross profit margins?
I'm sorry, when you say power and fuel cost is corrected a lot, what is that lot correction? I mean, what are you comparing with what?
Hello?
You know, when you're saying power and fuel cost is corrected a lot, right? What is that comparison? What are you comparing with? Because power and fuel cost, if you see on the numbers, right, this is on production. Our production is lesser this quarter. Production in the previous quarter was more. So if you're comparing, please map it up with the production, because the number which you're seeing is based on the production and not on based on sales. I'll repeat the numbers for your reference. So if I have to talk on QOQ, right, inclusive of power and fuel cost, right, we have improved our margins by 1.2%, and if I talk of YOY, the margins have improved by 0.9%. Right? And then you can do that calculation. Power and fuel cost is a part of it.
Okay, sir. And okay, sir, that's it. My question has been answered. Thank you.
Thank you.
Thank you.
Thank you. The next question is from the line of Pradeep, an individual investor. Please go ahead.
Yeah, hello, hi. Is it audible? Hello?
Yes, please.
Yeah, thank you for the opportunity, sir. So just wanted to know about this anti-dumping duty dynamics. So currently, as you are aware, recently this GCC nation has lifted the anti-dumping duty on India, and then the EU has started to levy anti-dumping duty on exports from India around, say, 7 to 8%. So what is the impact on that? And have they also done any action on China? And then what is the current position of U.S. anti-dumping duty on China? So just some more color on the anti-dumping duties.
So there's no anti-dumping in the U.S. for Indian products. There is an anti-dumping in the U.S. for Chinese products. That is why Morbi's single largest export country today is the U.S. As far as Europe is concerned, China has a higher anti-dumping duty in Europe, and India has a very, very low anti-dumping duty of 6 to 7%, so it's really not mattering. In fact, Turkey, which is the other competition to India, also has a much higher anti-dumping duty in Europe from Turkey. So that was the latest anti-dumping duty which was levied on India, but it was insignificant. As far as UAE is concerned, anti-dumping duty has gone, and we are also hoping that in the other Middle Eastern countries, this would be either lowered or would go.
Okay. So any now, as of now, the EU has levied some 6 to 7% duty on India. Anything on China also, or it is only on India and Turkey?
No, like I said, China has a much larger anti-dumping duty in the EU than India.
Okay, sir.
Okay, so India is clearly in an advantageous position.
Okay, sir. Thank you. Thanks a lot.
Thank you. The next question is from the line of Rishikesh Bhagat from Kotak Mutual Fund. Please go ahead.
Yeah. Hi. Good afternoon. Thank you for the opportunity. So my question is, first of all, congratulations on the great job done on the working capital front. Now, clearly, it's much leaner. Balance sheet is much leaner compared to past. So the question here is, this has been done obviously in the challenging demand environment. So in case, as you highlighted, if the sentiment has improved, can we further improve, or do you think we will require further any investment on the working capital front?
I think we are in good shape as far as the debtors are concerned. On the inventory, I think there is work to be done. We should be able to, if demand picks up, we should be able to shave off a couple of days on the inventory front.
Okay. Then incrementally from here on, if I look at it beyond Nepal, there is not much capex, so the cash generation will be fairly significant. So how should we look at incremental capital allocation from here on? Because Nepal, I don't see more than 40-50 crore incremental investment from your end.
That's correct. So therefore, there is not going to be a very significant expansion, because the next expansion would probably a sanitary ware expansion, which would be nowhere as expensive as a tile expansion. So that would be there, but that also will be there only in FY25, maybe 26, so spread into 26. So 2 years from today, 1.5 years from today. So other than that, whatever cash we generate, I think next year when we generate the cash, we'll probably let you know and think as to how we would want to deploy the cash. Obviously, it would be in the lines of prudent capital management. There are only 3-4 choices, either to expand or to buy back or to reward shareholders. We don't know. We're waiting to see what is the kind of cash balance we would have.
Sure. Thank you. That's it from my side.
Thank you.
Thank you. The next question is from the line of Udit Kajawala from Yes Securities. Please go ahead.
Yeah, I said just one follow-up on the margin end. When you say there will be 60 bips improvement from the savings in the gas cost, where do you see your full year for 24 panning out on the margin front?
I think the way the gas price is going, if it stabilizes here, maybe a little more should come out of the gas pricing. Other than that, all the other margin expansion which we definitely are expecting is out of capacity utilization and higher value-added sales. So both of them we had guided for close to a double digit, so anywhere between 9.5 to 10.5% margin is what we had guided in the beginning of the year. We still want to stand by that.
That's helpful. Thank you.
Thank you.
Thank you. The next question is from the line of Jinesh Karia from Antique Stock Broking. Please go ahead.
Yes, thank you so much for the follow-up, sir. I would like to continue on my gross margin question. If I look at your per square meter margins on the production volumes, so your power and fuel cost has reduced on a sequential basis by 3%, from 114 rupees in last quarter per square meter to 110 currently. However, your other raw material cost has increased by 11%, from 230 per square meter in last quarter to 255. I just want to understand why is the other raw material cost increasing?
So two factors to understand here. One is there's a decline in the power cost. This is purely on account of reduction in power. Right? There's a reduction in the fuel cost, it is reduced. As far as other raw material costs improves, there's an increase in other raw material costs, but please adjust it to production, right? Our production is lesser this quarter. We have utilized lesser capacity.
I'm talking on per square meter basis, so that's why. On production volumes.
On which number you are referring to? If you can just refer.
So last quarter, we had approximately 311 crores of raw material consumed and changes in inventory and purchase of stock material, and production volumes of approximately 13.5 million square meter. So that gives me
So Janesh, Sunny here. So basically, if you talk on sequential basis, Q4 we had a power and fuel cost per square meter was 114 rupees, which has come down to 110 rupees this quarter. And that was primarily in line with the reduction in gas price, wherein it was reduced by almost 5 rupees, from 50 rupees blended average for Q4 to 45 rupees in Q1, right? So that's primarily on account of that. Now, if you talk about the higher operating cost, that was already clarified earlier, that was primarily because of the lower capacity utilization which we had during the current quarter. Now, if you talk about the material cost consumption per se per square meter is almost flattish. It was 114 rupees in Q4 versus 115 rupees in Q1.
Okay. Maybe I'm missing something. I'll rework and connect with you maybe offline.
Yeah, you may please refer the volume number given in our investor deck presentation, right? And then you can just simply divide the absolute number of the consumption given, and then you will get the number. Still you can connect offline.
Sure, sir. And just one last thing. What is our aspiration maybe 3 years, 4 years down the line for the bathware segment? Where do we see the margins and revenue profile for that segment, given the competitive intensity from private players also increasing in the space? And that would be my last question. Thank you.
So bathware, we are looking at a 300 plus crore rupee revenue this year, and that runs at a good 3 to 4% higher EBITDA than the tile business. And the more and more that grows, the more and more the EBITDA would grow closer to the 14-15%. So that's the vision. In the next 5 years, next to 3 to 5 years, we're looking at 500 plus crore rupee revenue from the bathware business.
So, thank you. That's helpful, sir, and all the best.
Thank you. A reminder to the participants, if you wish to ask a question, please press star then 1 on your touchtone telephone. The next question is from the line of Achal Lohade from JM Financial. Please go ahead.
Yeah, thank you for the follow-up. If you could remind us, what is the blended cost for 1Q FY23, 4Q FY23, and 1Q FY24? I'm just trying to clarify.
Blended cost for what, Achal? Clarify, please.
For gas, sorry.
I'll take you through slowly, okay. The blended cost in last year, Q4, was 50 rupees.
Okay.
Last year, Q1 was 61 rupees. And this year, Q1 is 45 rupees. And currently, as we speak, in August, it is 41 rupees.
Perfect. So basically, while the blended cost did decline by about 5% QOQ, the actual is not declined as much, but that's okay. The second question I had was with respect to the capacity addition. Now, you mentioned that your capacity has gone up by about 25%. What
will go up after the new plant starts, approximately. Mota.
Right. So, what I'm trying to understand, on one hand, we have a significant exports playing out. On the other hand, there is also capacity addition, but I wanted to check your perspective on how Morbi is seeing capacities. Have you seen Morbi adding more capacities, or that is slowed down in terms of new capacity additions?
Sure. Yeah, let me answer that. So, if you see the maximum capacity addition happened between FY21-22 and 22-23, right? Last 2 years. So that capacity was basically put in by Morbi in a very big way. Considering the industry leader and us are in volume, we may be very large as single players, but we're very small in the entire universe. So we added capacity of about 18-19%, and we added capacity now by about 24-25% after the large format plant starts. Morbi also added a large capacity. This capacity Morbi added in between 21, 22, 23 was predominantly for exports. Now, what happened is when the capacity started coming in, which was just before the Ukraine war, so sometime in last Jan is when the capacity started kicking in Morbi. The freight rates started moving up very substantially, and so did the gas rates. And the war only made it worse. So therefore, a lot of the exports got hit. A lot of the traders were waiting for this to go down and then to buy. So the exports went down from whatever figure it was to about 500-600 crores per month in the whole of last year, especially in the beginning of last year. That started picking up to a good 12 to 1300 crore rupees towards the end of last year. And as we speak, we are looking at between 17 to 1800 crores of exports, which is happening per month from Morbi. So you can see the swing from a down of 600-700 crores up to 1700-1800 crore rupees a month. So a lot of that capacity which came up for exports has started getting utilized for exactly what it was put for. Coming to your other question, is there more capacity coming? There is no significant capacity coming. There are maybe 5 or 7 plants, 10 plants coming in, but that many plants are also shutting down in terms of line shutting down. So it's kind of balancing out. So we don't see any significant capacity addition in this particular year, other than you've seen industry leaders' plants start this month. Our plant will start early third quarter, October third quarter, and maybe 7-8 plants of various natures would mushroom in this year, but no significant capacity addition, if that is what you're asking. I hope I've been able to clarify.
But as a follow-up to that is that if export is so strong and if Morbi players are making reasonably healthy margins, is there a risk? Because we have seen in the past, whenever they have made substantial profits in any of the product category, they keep on adding capacity. So is there a change in the behavior this time around? Do you expect that?
Yes, there's a change in behavior for a couple of reasons. A, there's a lot of capacity which is still sitting unutilized. If you see, Morbi is still at 70% capacity utilization. A large part of that capacity is in wall tiles, which is lying idle. The other reason is that there has been a significant price increase of land in Morbi, which means that it's becoming that much less viable for any capacity to come in. Coupled with that, I think Morbi has also learnt its lesson where the margins were not as much. So therefore, the payback of the plant, which was much faster, has become longer in terms of both the land prices plus the rupee dollar. They were buying capacity. All this capacity, what you see or what you have witnessed in the last 3 years, has come 75 to a dollar and 80 to a euro. Today we're looking at 85 to a dollar and 92 to a euro. So this also is a good 15 to 20% plants becoming more expensive. And the rate of tiles has remained steady or have only gone down. So coupled with that, obviously all of these factors make it less viable for any capacity to come in. I'm not saying that it's not viable, but it's less viable for somebody to put mindless capacity. That's what I'm getting at.
Yeah, sounds, this is very, very helpful, sir. And just one question with respect to the sanitary ware, the bathware business. We've seen kind of a fairly sluggish growth if you look at from like when we launched and what we have achieved till now. So in terms of the competitive intensity, has it gone up tremendously in bathware? That's where you find it difficult to grow given the smaller base you are at. And is there a challenge in terms of the growth itself, in terms of demand side itself?
No, I think the base is small, the demand is huge. I'm not seeing that. Last quarter, I think for South, for some reason, was very poor as far as the demand is concerned. North did very well. In fact, West also did decent. But South really let us down in for whatever reason. As far as the competition is concerned, our competition, we're not seeing so much intense competition with the pipe players. They are struggling. A lot of the pipe players are struggling as far as sanitary ware is concerned. It's not an easy product. And also the distribution is not the same. For tiles, the distribution is the same. So disagree on most of the points. I don't see a challenge as of now to grow in this segment. It's a question of how we play ourselves smarter and make ourselves better in terms of getting market share, especially in the South. So it's all on us and really not on the competition. I'm not seeing that issue.
Got it.
So where we have not done well, it's better to acknowledge we've not done well rather than beat around the bush. So clearly in the South, sanitary ware has not done as well, and we're correcting that to see how we can sell more in the South.
Understood. And just a data question. Can you break it up in terms of bathware? How much is sanitary and faucet mix for this quarter and 1Q FY23 as well?
For last year, you mean?
Yeah, for this quarter as well as last year, same quarter.
Okay. So FY23 last year was sanitary ware was 33, and we are at just above 33, so no growth in sanitary ware. Bath fitting was around 20. There we've done 26, so about a 20% growth there.
Understood. Thank you so much and wish you all the best.
Thank you.
Thank you. The next question is from the line of Karan Batelia from Asian Market Securities. Please go ahead.
question. While the top 2-3 organized players have not taken cut on the MRP for tiles, so even Morbi is not resorted to cut in MRP, or how do you look at things now?
So MRP is a function of the discounting where the dealer discounts the product on the MRP. So I'm not sure whom you're referring to, but we haven't taken any serious cuts on MRP. It's generally a function if a product has become a vanilla item and sometimes you have not looked at the MRP so closely. Those are corrections which we keep making. The large correction when we made was when we moved from excise to GST. That was a big correction which we made in MRP. But we haven't done any such correction on our MRP. So I'm really not sure whom you're referring to, sir.
Right. So even at 40 rupees average fuel cost for the next couple of quarters, will be still not going with cuts in MRP?
No, like I said, MRP is not a function of pricing in the market.
Right. And also, Kumar sir,
it's a function of when you're ex-factory and how far you're selling it. So MRP includes ex-factory pricing, profit, insurance, freight, dealer margin, sub-dealer margin, etc., and then we put an MRP. So typically the MRP is in the industry, I'm not talking of Somany, but in the industry is about 30 to 50% of the ex-factory cost.
Okay. Thanks. That was very helpful. And Kumar sir, if you can break up the capex for FY24.
You asking me?
Capex breakup for this year.
Right.
Second, sir, capex breakup for FY24 is the only ongoing project, which is the slab plant, which is going on, and majority of cost is already done till now, because now we are on the verge of completing the project, and it would start from the early Q3. Other than that, we have just a maintenance capex, which used to be somewhere around 40-50 crore rupee on a total blended level at a Concall level.
Okay, so somewhere we are less than 100 crores of outlay this year.
Max. Yeah.
Okay, thank you. That's it for mine. Since there are no follow-ups, any closing remarks, team, you want to make?
Thank you so much, ladies and gentlemen, for coming and attending our Q1 earnings call. We're looking forward to a much better quarter 2 and hope to see you very soon in the quarter 2 or H1 earnings call. Thank you so much for being with us.
Thank you very much.